In this episode, we are going to answer the question, how can I access my IUL cash values totally tax-free? This is episode 11 of 21 in a series titled Secrets to a Tax-Free Retirement. This is a free course that is designed to empower you to accumulate an extra $1 million or more that can generate $100,000 a year of tax-free income for as long as you live. So put your seatbelt on. I'm going to blow you away. I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist for more than 45 years. My favorite vehicle of four that most retirees draw from during retirement is the tax-free bucket. It's an indexed universal life insurance contract that is maximum funded. I affectionately call it the laser fund because it passes the liquidity safety rate of return test with flying colors and is tax-free as icing on the cake. Now, I have explained in previous episodes the history behind indexed universal life and just universal life in general, why it's a sacred cow, and why it's tax-free under sections 72E, 7702 and 101A of the Internal Revenue Code. Now, 72E, if you remember, allows you to accumulate your money tax-free. Section 101A says that when you die, it blossoms, increases in value, and transfers income tax-free. But we're talking about section 7702 in this episode. This addresses how you can access your money tax-free while you're alive. In actuality, there are three ways you can access money: the sad way, the dumb way, and the smart way. I think I know which one you would prefer, but before we go into the smart way, I want to explain the sad way and the dumb way so that you don't take those options unless you absolutely have to, and then it's still far better than most other investments, but I would recommend you do it the smart way. Now, from previous episodes, if you viewed them, the money inside of an insurance policy accumulates tax-free, but if you ever happen to die, sooner or later, the cash value inside the insurance policy blossoms. It increases in value and transfers income tax-free. For a 60-year-old, the objective, again, if you're trying to do it for living benefits, you want the least amount of insurance you can get away with and put in the most money the IRS allows. So for a person age 60, if you wanted to put in $500,000, the minimum amount of insurance under TEFRA and DEFRA tax citations would be $1,250,000 or thereabouts. That means if I put in $500,000 and I died the next day in an accident, the insurance company is obligated to pay $1,250,000 tax-free to my heirs, my beneficiaries. So they actually were on the hook for $750,000 of risk, and that's all they charged me for. Now, that is what I call the sad way, okay? You have to die. Now, the sad way, I have actually had people who intended to accumulate the money and retire 30 or 40 years down the road, but they got cancer. They got killed in an accident. My own brother, who we were accumulating money for his retirement, was killed in an automobile accident. And so every bit of money in there blossomed and transferred income tax-free. So it's the sad way. You die, but it's one heck of a return, but I would not recommend it, okay? But that's why you have the insurance there, that if something happens to you, if you die with what is called a premature or untimely death, it's the sad way to access money, but it blossoms and it's income tax-free. Now, what's the dumb way to access money? That would be triggering unnecessary tax. The beauty of a max-funded insurance contract and the whole idea behind E.F. Hutton coming up with the idea back in 1980 was for tax-free access, for living benefits. And so you would have to do something dumb to pay tax on it. So let me explain when it would be taxable by doing something dumb or stupid. So life insurance in the Internal Revenue Code is taxed FIFO. That means first in, first out, compared to most investments or annuities. An annuity is a savings account with an insurance company. That's taxed LIFO. Let me explain it this way. If I put $500,000 into an annuity and I wanted to start income immediately, and let's say they're willing to give me a 10% payout. Very few will do that, but let's keep it simple. So I put in $500,000 and I'm getting $50,000 a year. Now, if that's the payout or the interest, I have to pay tax on the last money I'm earning, the interest. I have to pay it first. That's LIFO, last in, first out. And so if I started taking $50,000 out of the annuity and that was all interest, I have to pay tax every year on that. It's only when I finally dip into the basis that I don't have to pay tax. If it's an IRA or 401k, it's all taxable. That's called LIFO tax treatment. Life insurance is taxed FIFO, first in, first out. So in that same example, if I put in $500,000 and I'm earning 10%, which I've done for 25 years as an average, I could start pulling out $50,000 and I can call it a withdrawal, and I'm withdrawing my basis first. So the first money I put in, the $500,000, is the first money coming out. So at $50,000 a year, the equivalent of my interest, it would take me 10 years before I have recovered my basis. First money in, first money out. So the first 10 years in that example, it's tax-free. Now, here's the problem. In the 11th year on, if I'm still earning 10% and I keep pulling out $50,000, now I've recovered my basis. I already paid tax on that. That's why it was tax-free the first 10 years. Now I have to start paying tax on the 50 grand a year starting the 11th year. Now, FIFO tax treatment is better than LIFO, but you don't have to do that. The IRS says, no. You don't have to pay unnecessary tax. Change the nomenclature. Don't call it a withdrawal. Call it a loan. What? Borrow your own money? Watch. So under FIFO tax treatment, you can take withdrawals out of your insurance policy up to your basis and then switch to loans thereafter. But I don't. I start using loans day one. And in the next 2 episodes, I will explain why that is the smarter way to go. But if you borrow money out of your insurance policy, people say, what? You're borrowing your own money? They're going to charge you interest. Now listen close to how this works. There's a lot of advisors that don't understand this. Let's say I had $1 million in my insurance policy and I'm earning 10%. Now I can withdraw my money, but that may be the dumb thing to do because I'm permanently lowering the ability of my insurance to accommodate new money if I ever want to reinvest down the road. But after I've recovered my basis, now I have to start paying tax on the $100,000. I change the nomenclature to borrowing. I want a loan. Now, if you had money, if you had $1 million in a bank, and you wanted to go withdraw your money, they would stop paying you interest on that. Or if the bank said, you know what, we'll keep paying you interest, but you can borrow the equivalent of your interest and we'll charge you 5% or whatever. Well, a lot of times banks, they're pretty pathetic. They may only pay you 1%. So why would you do that when they're only paying you 1% and they're charging you 5%? With the insurance company, it's the opposite. So if I borrow my money out, if I'm earning $100,000 a year in interest on my $1 million, I just say, okay, leave my million alone. Leave it there earning interest. And if it's earning 10%, $1 million keeps growing. $1,100,000, $1,200,000, only it's compounding. They loan you the equivalent of your interest. So my balance divides into 2 on my statement. I have this phantom loan balance here. I have 100,000 next year, another 100. So it's 200, 300, 400. Why do I call it phantom? Because the loan is not due and payable during my lifetime. And it's washed away. It's forgiven. It's washed out when I die with the death benefit because the loan balance is increasing, but my cash value is growing, compounding, and it stays ahead of this. This growing tax-free minus this loan balance equals the same amount that I would have had in there had I been withdrawing my money and paying taxes. By doing this, I avoid paying tax because loan proceeds are not deemed earned, passive, or portfolio income. Those are the only three types of income Americans pay income tax on since 1986. And so when you have loan proceeds, that is not taxable income. It's that cut and dry. There's nowhere on a tax return to put a loan proceed out of an insurance policy. It's tax-free. So let me summarize this. I borrow the equivalent of my annual interest. I borrow it and this phantom loan balance grows, but you have your cash values that grow. This, at any given time, minus this equals the same amount you would have had you been withdrawing money and not earning interest anymore. Now, the insurance company, to deem it a true loan, is required to charge you a nominal interest rate, and that is defined year by year. They may charge you 2% on your loan balance, but they will credit you an interest on this side. It's usually what is called a zero-wash loan. That is the simplest option. They charge 2%, but they credit you 2% on the amount of this money that collateralized this loan. So they're charging you 2, they're crediting you 2. What's the net cost? 0. Well, that's called a zero-wash loan. Now, folks, that will generate tax-free income. I've had people that have been taking $100,000 a year or more in tax-free income for 30 years. 30 years times 100,000. They have a $3 million loan balance over here, but their cash value has grown by more than $3 million. This minus this equals the same amount had they been pulling it out the dumb way and paying taxes all of those years on that income. So the key takeaways of this episode is there are 3 ways you can access money out of an insurance policy: the sad way, dumb way, and smart way. The sad way is by dying. One heck of a return, but I don't recommend that one. The dumb way would be to trigger unnecessary tax after you've recovered your basis under FIFO tax treatment. I prefer the smart way. The smart way, if you're very conservative, you simply borrow the equivalent of your interest and you leave your money there compounding tax-free that is collateralizing the amount you're borrowing. And this stays ahead of this. When you die, this minus this gives you the same death benefit that you would have had you pulled it out the dumb way and been paying taxes all of those years unnecessarily. So if you want to learn more about this, I want you to watch this episode next, because I'm going to show you the absolute smartest way to access your money and borrow it, like the millionaires and billionaires do. But in the meantime, if you want to study this book, The Laser Fund, is my 11th book, 300 pages of charts, graphs, explanations, and 62 actual client stories, I would invite you to claim your free copy of this book. Go to laserfund.com. I'll pay for the book. You pay $5.95 shipping and handling. I'll fire out a copy for you, and you can study and read and learn. You can listen and learn. There's all kinds of formats of this book available for you.